Hello, hi, good morning, welcome. Thanks very much for joining us today. My name is Gary Tuffield. I'm a partner at Goodhart Partners, who partner with AVI. I'm joined today by Tom Treanor, who's head of research at AVI. Tom specializes in closed-end funds, and we're going to be spending quite a bit of time this morning talking about closed-end funds and the opportunity within the alternative space. I'm also joined by Wilfrid Craigie, who is currently on holiday in the south of France. So thank you, Wilf, for taking the time out of your holiday to talk us through what's going on with companies in the holding company space, which Wilf heads up. I'm also joined by Helen Mattia. Helen is head of IR at AVI. So many of you will be familiar with AVI. For those of you that are new to the business, just a quick reminder of what they do. So AVI are an employee-owned business. They've been around since 1985, upon winning what was then known as the British Empire Trust, which was a £6 million trust at the time. That trust has grown significantly and currently today sits on 1.3 billion in AUM, so grown significantly. The firm managed in total 1.8 billion, having launched a Japanese trust in 2018, and just over a year ago took over the MIGO trust that joined in 2023. So as most of you will know, AVI are very differentiated. They're bottom-up, benchmark agnostic, and very research-driven. They're finding ideas in parts of the market that are prone to inefficiencies, and we're going to talk about how and why those inefficiencies exist and how AVI are looking to close those large discounts that are currently on offer in the marketplace at the moment. AVI are an engaged investor, so they're an activist investor. They're actively engaging with businesses to try and close those discounts. And as you will be aware, very well resourced. There's a 13-strong investment team and very low employee turnover. Just a quick highlight on the track record. AVI, as mentioned, have been managing the trust since 1985. It's been compounding at 11.5% per annum. Net of fees outperforming the MSCI World Index by just over 2%, and the MSCI All Country World Index ex-US by just over 3%. So very attractive returns. What's more impressive, and I always find interesting, is that through most of that period, their exposure to US equities or direct exposure has been very low. Originally, the trust was used by endowments and foundations to get international exposure, hence the very low weighting to US equities. I'm now going to hand to Helen, who's going to talk you through how you can access the three strategies.
Good morning, everybody. As you can see on the screen, AVI has three strategies you can access in both a closed and open-ended format. We have the global strategy, which invests in closed-ended funds, asset-backed companies, and holding companies. We then have the Japan strategy, which invests in small and mid-cap Japanese companies with a highly activist, engagement-led approach. And then finally, we have the closed-ended fund strategy. This is MIGO and AVI Worldwide Opportunities, which Gary mentioned joined us last year. And these funds both invest in deeply discounted closed-end funds, often with a catalyst.
So we're now going to hand over to Tom, who's going to walk us through AVI's philosophy and what we think is different about the approach.
Hi there, morning. So at a high level, we're looking for three rather straightforward things. We're looking for high quality growing assets that we like. We are trying to buy those assets at material discount to NAV. And we're looking for some sort of event or corporate catalyst that will eliminate or substantially narrow that discount to NAV. If you break down the three constituent parts there, we want assets to be going up for a couple of reasons. One, because clearly we benefit from a growing NAV. Secondly, because it allows time to be your friend here. If you're waiting for a catalyst to play out, what you don't want is the NAV going down over that period and making you heavily reliant on that event happening to generate a return. On the discount part of the equation, we have a proprietary database of around 500 sum of the parts modelled companies with NAV and discount hedges for all of them. That really allows us to interrogate whether a discount is out of whack versus its peers, versus its own history, and where it sits in absolute terms as well. Now, clearly, all else equal, the wider the discount, the better, but all else is very rarely equal. And what we really want to avoid is a situation where a discount stays wide for a long period of time. And due to that, that's why the event angle is so important to us. This can be an organic event, if you like, from the company itself. The company may feel the need to do things like buy back stock, do tender offers, but very often, particularly in Japan and the closed-end fund space, we take very large stakes in these companies and we actively engage to try and crystallize value from those companies. And that could be very aggressive measures like a wind up or sale of the company, perhaps in certain cases. So those are the three things we look for. And when you get all three in combination, you get a very powerful compounding effect from that. So to our universe, we've been doing this, as Gary said, for a long time, since 1985. And our universe really spans a seemingly quite disparate bunch of types of companies. So holding companies in the US, Europe, Asia, conglomerates across the world, small cap Japan companies, London listed closed-end funds. It's really our job from that universe to pick a core portfolio of 20 to 30 names that fit the three criteria we mentioned before. So wide discount to assets that we like, trading at a discount to NAV. Now, why do discounts and opportunity exist? There's a few factors we listed here, all of which we think will deter certain investors from taking a further look at these companies. Things like complex structures. There may be what we call a cascade holding company structure where you have multiple holdcos above the listco. There may be strong family ownership. There may be dual share classes where some have more voting rights than others. But really, again, if you take the time to understand those structures, that can certainly unearth opportunities for us. We find in general in a universe that sell-side coverage is particularly low. But the main reason for that is that a lot of these companies fall between two or three stools at an investment bank. If you have a conglomerate that has, say, utilities, banking, and retail holdings, it's never clear which analyst department should be covering that particular company. Private assets that we'll touch on a lot more today. There's clearly a lot of opacity there around what the true value is for unquoted assets. We see as opportunity to dig deep into the holdings and try and unearth value that the market may not be completely appreciating. Controlling shareholders. The holding companies we invest in tend to have a family there that's a dominant presence. So you need to be comfortable with the alignment of interest there, look at the history, have they treated minority shareholders fairly over time, and then engagement, which we'll touch upon much more later on.
Thanks,
over
Tom.
to Will for the next slide.
Thanks, Tom. So whilst that can all sound quite abstract, I think it makes sense to bring together what we do with a case study. And FEMSA, which is a Mexican family-controlled holding company, really brings all of this together. So the family's wealth emanates from the founding of the first brewery in Mexico in the 1890s, and the brewing assets performed well throughout the 20th century, such that in 2010 they sold their brewing assets to Heineken, and they received stock in Heineken. However, it wasn't this that interested us. It was an unlisted business held within the structure called OXXO that was of most interest. So OXXO is the largest convenience store operator in Mexico and Latin America. They have about 22,000 units. These are small stores that cost about $150,000 to fit out and earn high returns on capital employed with payback periods just shy of 3 years. The average ticket size is about $1.50, and customers are principally motivated by convenience, not price. And these are growing very, very strongly. So they open a new store about every 6 hours and have a long growth runway. So you've got a high quality business, but it was stuck in this conglomerate group structure. And as such, the market was mispricing it. So when you stripped out the stake in Heineken, a listed stake in a Coca-Cola bottling business, and some other non-core assets, you were paying about an implied 6 times EBITDA for OXO. OXO's closest peer, Walmex, traded at more like 13 to 14 times. So you had a high-quality business, a discounted valuation, but it's the third leg, the event, that made it become one of our largest positions. So in 2022, the family initiated a strategic review to unlock value, and this culminated in them exiting Heineken. So they sold the stake, realized a significant portion of their market cap in cash, and eventually started to return this to shareholders, launching the first buyback in the company's history. So this is an example that really hits those 3 points of asset value investing and is indicative of what we're trying to achieve. So here is the portfolio top 10. I think one interesting thing I'll come on to talk about is that whilst many of the names here you might not know, lots of the underlying holdings you might be more familiar with. But as things stand, it's a relatively concentrated portfolio, and discounts are wide, as we'll come on to discuss, with the portfolio weighted average discount standing at about 38%. In that far column on the right, you can see the percentage of the portfolio that is unlisted. And that's something we're going to bring out today, is that through these listed structures, we get access to unlisted businesses. And this is a very interesting strategy because these can be some of the most misvalued and misunderstood opportunities, as the previous example as FEMSA highlighted. But just on the look-through exposure, so whilst we run a relatively concentrated portfolio of about 30 stocks, the inherent diversification of holding company structures means you're exposed to nearly 10 times as many underlying companies. And as I said, whilst you might not have heard of Exor, it's likely you will have heard of Stellantis and Ferrari. So we're buying often blue chip, high quality growing businesses at deeply discounted valuations. The other point to bring out here is the geographic exposure. And as Gary said earlier, whilst we have, for most of our investing history since 1985, had relatively low US exposure, that's increased in recent years to just shy of 30%. However, this is obviously much below the MSCI World Index, which is now close to 70%. So whilst we offer broad-based equity exposure, we look very different to the benchmark, and we do not try and mimic that. We're very much a bottom-up best ideas portfolio focused on the greatest combination of NAV growth potential and discount narrowing, not some benchmark allocation.
I touched earlier upon engagement and the importance there of that factor in narrowing discounts and sometimes completely eliminating them entirely. But the picture is quite nuanced in terms of how we engage with companies, and it varies depending on the type of company and the particular case-by-case stock that we're in. So as a starting point, our preference is always, or rather, our starting point is that engagement always begins in private, and our preference is that it stays private. We don't ever set out to a public campaign somewhere, and that will always be the last resort from our point of view if we're not getting anywhere with our private dialogue with managements and boards. But what we do find in our private engagement is that the fact we have shown a willingness to go public in the past means we're more likely to get results when we do engage in private. There's 3 buckets of companies here that we use to illustrate the point. So Exor and Investor, both extraordinarily well-run, what we would call blue chip holding companies in Europe, run by very engaged families, extremely strong track record of NAV growth and capital allocation. And engagement there really is limited to regular meetings with management. We may put ideas forward to them, but it's definitely much more the passive end of the engagement story there. Somewhere in the middle are the likes of Schibsted and FEMSA, which were and are both family-controlled vehicles, but where poor capital allocation decisions over time had led to outside pressure on management and the families. And there's opportunity there for us to engage with the companies, which ended very successfully when they spun off, in both cases, key assets that were non-core to the story, and we saw a very material re-rating in the share price. The bottom category is where engagement is much more hands-on, and this will really be where we've reached the end of the road in engaging privately with these companies. There'll generally be here very serious and severe governance issues, perhaps very poor capital allocation, and more often than not, a very persistent and perpetually wide discount to NAV. And we'll touch upon one of those stocks a bit later on. Just to begin, a few case studies that will take you through. I think Chris is a great example of a couple of things. One of engagement with the largest shareholder. We own around a 13% stake across all of our funds, and we're very actively engaged right now with the board of this company about where it goes from here. It's also a great example of the tendency of markets to overshoot in both directions. So this is a late stage private growth focused closed-end fund, came to market in late 2018. Very quickly went to a large premium to NAV, which got very much out of hand in 2021, around a time that the likes of SoftBank and Tiger were chucking money at any late stage company. The shares, having launched at 100p a share, went to 275p a share. And then we obviously saw the interest rate hiking cycle begin in late 2021, early 2022. And that led to a very savage de-rating in the shares. And what it meant was we were able to acquire our stake in Chrysalis at discounts approaching 50% to an NAV that had been written down by 40% over that time. Now the shares are up around 20-25% or so since we acquired our stake, but they're still at a very deep discount to NAV, and the market cap today is covered by their holdings in Starling, Klarna, and cash on the balance sheet as well. It really does tick all the three boxes. We have assets that we like, that we've done a huge amount of work on, with a deep discount to NAV, and the catalyst there is that the company has now launched a very material share buyback that will see them retire around a fifth of the shares in issue over the next 6 months or so. The question, of course, with private assets, the topic here of this webinar, is how real is that NAV, and correspondingly, how real is that discount to NAV as well? And there's a few ways you can come at that. You know, you can look at the acid test, if you like, of when they realise investments, when they exit them. Do those exits come at premium to carrying value or not? Very recently, they sold both Graphcore and Featurespace, which went at 21 and 25% premiums to the prior carrying value. We can also look at the holdings as well. So Klarna is a large holding for Chrysalis. It's about 15% of NAV, and they're carried at around a $15 billion enterprise value for the company. So when we look at, or rather when we speak to private brokers who make a market in Klarna stock, trades are going through right now around $13.5 to $14 billion. So a little bit under where it's being carried, but certainly provides a floor to the valuation. We then have a listed peer called Affirm over in the US. And if we apply Affirm's sales multiples to Klarna, we get to a $25 to $30 billion valuation. And then finally, there are press reports out there that we think are quite reliable about an IPO range of between $15 to $20 billion. So there's a few points there that give us comfort in the carrying value of Klarna, and more broadly across the entire portfolio as well. So listed PE, this really refers here to the segment of the London listed closed-end fund market. There are 17 listed funds there, invest in private equity, and they're a mixture of either directs or they're fund of funds. On the direct side, names like HG Capital, Oakley, 3i that you may have heard of. On the fund of fund side, names like Harbourvest, Pantheon, and so on. And discounts have been very, very wide since late 2021 in the market. There's been a huge amount of pushback and general skepticism about how valid and appropriate those NAVs are. And again, correspondingly, are those discounts real? So the way we come at it, and our conclusion to spoiled conclusion rather, is that they are robust and that the discounts are genuine discounts to an AV. So a few points to make here. One, while it's not satisfactory from a purist perspective, the fact is that PE valuations lag the market on the way up and also on the way down. In 2021, we saw valuations not keep pace with public marks. So it makes sense as a buffer there that was used up by not taking material write-downs along the publics in 2021, 2022. There's the acid test I referred to earlier, where when these companies exit investments, they'll still come in at very large premium, between 20 to 40% to prior carrying values. Then I think the most salient and the most robust pushback here comes from the charts on this slide, where we can see here that there's a very active secondary market for stakes in third-party PE funds. So if you're Pantheon or Harvest today and you own 500 to 1,000 LP interests, you can go to the private market and dispose of those at around today a roughly 10% discount to NAV. You could then, in theory, use those proceeds to buy your own stock back at a 35 to 45% discount where they're trading in public markets. So a very clear arb there between public and private markets.
Thanks, Tom. So D'Ieteren is currently our largest holding in the fund, and it's a 7th generation Belgian family-controlled holding company. And it provides a great example of the exposure to unlisted or private assets that we look for, and the discounted valuation these can trade at within such structures. So, as I said, the family now into their 7th generation. A significant portion of the wealth was built from 1948 onwards, when they won the sole contract to distribute VW in Belgium. So they sell about 1 every 5 cars in Belgium. That was an okay business and made the family some money in the 20th century, but it's not that exciting. The exciting part is Belron, which they first acquired a stake in 1999. So Belron, or as you might know it, Autoglass, of Autoglass Repair, Autoglass Replace, is the world #1 in vehicle glass repair, replacement, and now recalibration. And it's the recalibration element that's so interesting to us. So as windscreens become more complex and we move towards driverless cars, ADAS cameras are fitted within the top of the windscreen. So when you replace a windscreen, you have to recalibrate the camera. And this has massively increased the technical specification of windscreen repair and really raised the bar for competitors. So mom and pop operators can't compete with this. Insurance companies want a high level of assurance that the job will be done properly. And the capital equipment for recalibration costs about 20,000 euros. So this has seen a significant tailwind in price and mix, but also they've continued to take share with nearly 45% market share in the US. So Belron is an attractive, growing business, but it's stuck in this supposedly kind of sleepy Belgian family-controlled holding company. That said, in 2018, D'Ieteren sold a 40% stake in Belron to private equity, to CD&R. That was at then $2.5 billion enterprise value. Only a few years later, a second deal occurred with another private equity interest, this time at a 21 billion enterprise value in 2021. And just a couple of weeks ago, we saw a third transaction, this time at a 32 billion enterprise value, which equates to about 19 times EBITDA. So clearly there's been significant value creation within Belron, and this seems really poorly reflected in D'Ieteren shares. So the stake in Belron is worth about 221 euros per D'Ieteren share, with D'Ieteren currently trading at about 200 euros a share. But the kicker, and the really interesting thing, is that the family are undergoing a kind of another generational transition as the two branches of the cousins become one. So that means one cousin is buying out another, and they need capital to do this. In order to fund this, D'Ieteren are paying a special dividend of 74 euros per share, and this will be paid at the start of next month, so in about 14 days' time. So we're seeing a very large portion of our market cap come back to us at NAV, and we believe that will act as a pull to par and really help the discount narrow. On an ex-dividend basis, the implied discount on D'Ieteren is more than 60%, and we think this is a fantastic valuation. And these are exactly the types of opportunities we like, where we can access high-quality, growing, unlisted businesses through listed structures. And then down the line, we expect there to be some kind of monetization event for Baron, perhaps another private equity sale or even an IPO, and that should help further make investors focus on the underlying value. On to another family-controlled holding company, News Corp. So News Corp is of course the Murdoch family-controlled holding company. It's a company that many people have heard of, but really very few understand the value of. So News Corp in its current form was split off from Fox in 2013, and it was called then New News Corp. And within it, they included a stake in REA Group. And REA Group is the Australian equivalent of Rightmove that many of you might have seen recently try to acquire Rightmove. And REA has performed very well. The shares are up maybe 400% since then, such that today that listed stake in REA accounts for nearly 80% of News Corp's market cap. So when you strip that out, you're paying a very low implied price for News Corp's other assets, or about 3 times EBITDA. And those other assets, the largest and most interesting is Dow Jones. So Dow Jones owns both the Wall Street Journal, which has very successfully transitioned to digital, with a wealthy readership base who are happy to pay for news. But they've also built and bought a collection of information services businesses, the largest of which is called Opus, which is a bit like Bloomberg, but for oil and gas and commodity markets. So it provides pricing, data, and analytics for such markets. It's a recurring revenue business with high margins and minimal capex requirements that really warrants a premium valuation. But within this conglomerate structure, it's not getting that. As I said, the stub assets, so net of the stake in REA, trade an implied 3 times EBITDA. The New York Times, the closest peer, trades at more like 17 times, and information services peers trade in the mid-20s. So you've got high quality growing businesses trading a deeply discounted valuation, but it's the third part, the catalyst, that means it's such a large position for us currently. So management have become increasingly vocal about unlocking value. Indeed, early this year, CEO Robert Thomson talked about having a revolution, not an evolution, in the corporate structure. And to us, the obvious revolution is an in-specie distribution or a spin-off in REA. This will really focus investor attention on the stub assets and force a re-rating in the shares. On the latest earnings call, Robert Thomson said, "Watch this space." So that's exactly what we're doing. And we think that change is afoot, and the market is really mispricing the potential for management to take such steps to unlock value.
Thanks, Wilf. I want to talk here about a little theme that is probably closer to the end than it is to the start for us. The alternative asset managers, both in the US and Europe. And 2 examples here, KKR and Apollo. KKR have exited earlier on this year. Apollo is still in the portfolio, but you can see there it's had a very material re-rating over that time, both of them acquired in 2020. So the thesis here was that the markets misunderstood this group of companies. The perception was, we think, that they were and are levered beta plays on financial markets. We would argue, and we did argue at the time, that although the performance fee income can be very volatile quarter on quarter, the real heart of the value, the bulk of the value of these companies lies in the fee-related earnings, where they're earning fixed and high percentage management fees on capital locked up for 10 years plus, where the asset base on which the fees are levied is cost or invested capital rather than on a mark-to-market basis. So a very predictable, recurring, visible, high quality and valuable earning stream there. There's also perception that a lot of these companies were just private equity plays. And while that was certainly the case when many of them came to market, it certainly wasn't when we acquired back in 2020 and definitely isn't now. If we take KKR, which listed in 2009, 3/4 of its AUM back then were in PE. It's now less than a third. And even within that third, it's diversified across growth equity, what they call core, much longer whole period PE, diversified across Asia, Europe, as well as the US. The other trend that we saw was that due to that fact, because these companies have become much more one-stop shops, offering real assets, real estate, infrastructure, credit, as well as the various types of PE, you're likely to see a consolidation of LP GP relationships. So what we have seen is that the secular tailwinds for industry have accrued in a disproportionate way to the larger players like KKR and Apollo. As I say, very strong returns thus far. But a really good case study there, I think, of an arbitrage between perception and the reality on the ground. We touched upon the role of engagement and activism earlier on in narrowing and eliminating discounts to NAV. This was a rather high-profile example, Hypnosis Songs Fund, essentially a fund that invests in music publishing royalties. So to put this in context, there's a big boom in alternative issuance of closed-end funds in the years following the GFC, when gilt rates were between 0 and 100 bips or so. People started looking for alternative income plays out there. And the industry responded to that with a wave of issuance of infrastructure vehicles, renewables, and more esoteric asset classes like perhaps shipping, and in this case here, as I say, music publishing royalties. Now, Song came to market, as I say, in 2019, performed very well for a while. We had a small stake in the company based upon what we saw as the sector attractions of the music industry and the likelihood that when it got scale, it'd be a very nice take-up target for a pension fund, insurance company, or an endowment perhaps. Having invested in the company, we became quite concerned about some discrepancies in accounting, corporate governance, and just generally very poor transparency when we asked more probing questions to management. So we sold the bulk of our stake, over half of it, at prices around 120, 130p or so, before the share price started falling very, very dramatically as interest rates rose, and then even more dramatically as more idiosyncratic concerns came to the fore. We boosted our stake very materially, took it up to our largest holding in our main fund in Q4 2023. And that was ahead of a continuation vote on the company's future. We publicly campaigned shareholders to vote against the continuation and against a related party sale to the manager, and we fought that off. We replaced some key members of the board, including the chairman, and installed some new, much more competent directors. And the outcome was the company was sold to Blackstone at a very large premium to the undisturbed price prior to all of that.
Thanks, Tom. So I really want to frame what we've been saying today in context and what we see as a very interesting juxtaposition. So whilst equity markets globally are reaching new highs, led by an increasingly narrow band of US technology companies, the parts of the world we look in and the ponds we fish in are really overlooked and misunderstood, and discounts are wide by historic standards. So the chart at the top shows European holding company discounts since 2013, and as you can see, they've really got a lot wider, and despite markets generally being more ebullient, they're now at levels kind of wider than during COVID, wider than during the GFC, and that to us is extremely interesting. Lots has been written about closed-end funds and the issues facing the sector, and this chart there for the discounts tells the same story. Discounts are very wide by historical standards. The bottom chart shows Japanese small caps, and again, we've got very wide discounts, although they've started to narrow from the very lows as the tailwinds for corporate governance reform have become better understood by other investors. But really, through these three buckets, we see very attractive, deeply discounted valuations, and that really gives us confidence as we look ahead.
Thanks, Will. I hope it's been helpful in terms of explaining what it is we do and why we think it works, and also from the last slide that Wilfrid showed why the time is now for our strategy as well. You know, not only wide discounts, elevated levels of corporate activity, families managed looking very hard at the undervaluation of their shares,